Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm delighted to welcome back not one but two special guests, Monique, Wong and Joe Aylott. We're going to find out in a sec what the three things are that we need to know. But before we get to that, Joe, last time you were on, I think you were talking about gold with David, but we were very remiss because we didn't get you to introduce yourself. So the microphone is yours. Very quickly, tell us who you are.
Hi, Sarah. Thanks for having me back on. I'm Joe Aylott. I work in our asset allocation team at Coutts, so working alongside lots of people that regular listeners of the podcast will be familiar with, including David, Farhad, Lillian, and others.
Brilliant. Thank you very much, Joe. Monique, welcome, Monique. Welcome back to Need to Know. Now, what are the three things that we need to be thinking about? It's back to work now. Everybody's coming back from their long summer vacations, getting back to the desk, going through the inbox. What are the three things we need to be focusing on as we sort of look towards the end of the year?
Hello, Sarah. Good to be back on the podcast as well. Yes, it's the end of summer holidays. So, that where you're at when you come back in the autumn. I think the first thing on the Need to Know today should be an update on the outlook for the economic environment and for markets to the end of the year or as far as the eye can reasonably see. Secondly, we are on the precipice of interest rate cuts from the US Federal Reserve. Now, as we know, interest rate cuts have already started. They started here in the UK, the Bank of England, the European Central Bank, the Swiss National Bank, the Bank of Canada. That list is growing because it is a global trend of interest rate cuts. The big one everybody is waiting for, obviously, is the US Federal Reserve, and we can discuss the expectations around that. Thirdly, we had market choppiness at the end of July, start of August. You discussed this on the podcast. Back in December, I was talking to you on the podcast about market dislocations and what you want to do when markets fall out of bed. Because we know at a particular level, markets become a buying opportunity when they decline. So I think we should talk about this within the context of the recent market movements.
Yeah, absolutely. And just to preempt that, we're obviously not giving advice here. We're talking about what happens to markets and how perhaps investors should be responding to what can be quite a challenging environment for them. Okay, well, let's get back to you, Joe, first of all, to kick off with our outlook for the rest of the year. Let's just sort of set that macroeconomic backdrop for us.
Sure. So as always in markets, I think that the market has been more volatile than the fundamental picture. And in our view, the fundamental picture has been fairly stable over the last few months. Our base case as we head into 2025 is for robust earnings growth, slowing economic growth, and benign inflation pressures. And I think if we think about our reasons why we have that fairly constructive outlook, they've also been fairly stable over the last year or so. And in short, that's because the US consumer continues to look in good shape. We've had periods over this cycle when housing's been weak, when manufacturing's been weak, but the consumer remains strong.
Okay, you talk about slowing growth. Now, that might ring alarm bells for some people, but we're not talking about recession, are we, at this stage?
No, exactly right. So we're talking about the rate of growth slowing down, but remaining positive. And I think importantly, at the moment, that slowing growth is actually important because the Fed needed growth to slow down a little bit to allow inflation to ease, and so that was actually something that the Federal Reserve were looking to happen, and we're now seeing it.
Yeah, and as you say, that's very important. We'll come to that in the second point because we're going to talk about rate cuts. But what about the role? What are we seeing in the labour market? Because up until sort of the first half of this year, it was quite tight, the US labour market. We've had some kind of fairly sort of varied sort of jobs reports coming out, and obviously we've got a big one coming out before the next Fed meeting. What's the trend in the overall trend in the US jobs market?
Yes, so the labour market has been slowing down, but like the economy, it's been slowing but remaining in positive territory in terms of growth. And I know you and David spoke about the SARM rule on the podcast a couple of weeks ago, which was the phenomenon we saw with the last jobs report, which showed that the unemployment rate had risen, and typically that's been a good recession indicator. I think, though, as we see the labour market slowing down, it's important to think about why these labour trends are occurring. And ultimately, that's because the Fed needed the economy to slow down and labor market demand to ease to allow them to fight inflation and bring inflation down. So obviously, as the rate of growth in the economy slowed from, say, 4% 9 or 12 months ago to closer to 2% today, the downside risks increase and the recession probability increases. Mm-hmm. And that's what we've seen in this recent bout of volatility. But so far, we've just seen falling job openings, falling hiring rates, but we haven't seen people being laid off. And that's what you would expect to see at the start of a recession, and that's not our base case going forward.
So, Joe, I mean, this sounds pretty positive. We've got the rate at which the US economy is growing is slowing down, and we need that if we want interest rate cuts to happen from the Fed. You've talked about a sort of less tight US labour market, but no layoffs, so it sounds pretty good. But what are the risks if things don't pan out as expected?
Yeah, so the main risk really is the labour market, and that's where we're kind of focusing a lot of our time at the moment. And if the labour market does slow down more than we're anticipating, that would raise the risk of recession and have significant negative financial market implications. Ultimately, though, the fact that central banks are no longer fighting inflation does reduce the risk of that inflation fight tipping the economy into recession, and that's a positive development, and that's part of the reason for our fairly constructive outlook on the economy moving forward.
Okay, thanks, Joe. Monique, coming to you now. I mean, obviously, we've got that macroeconomic backdrop, reasonably positive. How do we see that playing out in markets?
Yeah, that's a good question. So if I put everything that Joe said into a nutshell, inflation concerns falling away, the US economy is currently in expansion, and with some certainty, we can see it going into slowdown. Now, the important thing here is that slowdown is moderating, but positive growth. It is not a contraction. It is an environment where you would expect companies to be profitable, and companies underlie the stock market. So it's an environment which still favors equities. It still favors risky assets. And this plays out empirically in the historical analysis that we've done. You have the same conviction about owning equities in a slowdown as you do in expansion. I am going to nuance it by saying that the gap of equity outperformance over bonds is going to be narrower in a slowdown. And that is intuitive because bonds become more attractive when economies start to slow and you have the prospect of interest rate cuts. And therefore, you have the prospect of capital gains on bonds in addition to the 4% yield that you're going to earn.
Does that mean then you're getting less negative correlation then essentially between bonds and equities in that environment?
No. If we are expecting both equities and bonds to have a positive outcome, let's say over the next 6 to 12 months, it means that they're both positively correlated, but in our favor. And as we've said on this podcast several times, bonds are mathematical. So you earn that 4% yield. And 10-year treasuries, they are 6 duration bonds. What do we mean by that? It means that if bond yields fall 1%, then those bonds will experience a 6% capital gain. Now, I'm not predicting that you get a 1% decline in bond yields. That falls within the realms of possibility. So what do you earn on bonds? You earn a 4% yield, plus you earn a possible 6% of capital gains. That's your potential upside. That's 10% return on bonds over the next year, potentially, which is commensurate with equity returns. That's the point that I'm trying to get at.
Yeah, and obviously we're not making predictions because we don't know for sure, but that's what the expectations are. That's our base case. Okay, so generally then, it's looking reasonably good for equities and for bonds in this current environment if this continues without any kind of major upsets. Obviously, there's a lot that can happen between now and the end of the year. But so far, looking okay.
Yeah, and I should say, if you have a positive outlook for both bonds and equities, it means that it's a good outcome or a good environment for a balanced portfolio, which is a portfolio that has a decent balance between equities and bonds.
Yeah, absolutely. Okay, so that's the outlook. So, Joe, coming back to you, rate cuts. You alluded to it in the first section. We are looking to see when the Fed is going to cut rates. And obviously, expectations are we're going to get rate cuts this year. Having said that, we started the year thinking we were going to get maybe 5 or 6 rate cuts. we're now down to the stage where we might get maybe, I don't know, 2, 3 at the most. What's priced in as far as rate cuts and the Fed are concerned?
Yeah, sure. So it differs slightly across regions. Obviously, in the US, the market's expecting about 100 basis points of rate cuts this year. In the UK and Europe, where the cutting cycle's already started, the market's expecting slightly less. I think, though, it's easy to focus on the US or the UK, but actually this is a real global trend of broadening rate cuts. We're seeing more and more central banks participating in this. Around 6 central banks, I think 6 of the G10 central banks have already cut rates. And so although the magnitude and pace of rate cuts will differ, outside of Japan, developed market central banks are easing. This is a synchronized global trend. And so that has very significant implications for the business cycle and also financial markets.
Okay. Now we come to this coming to this point about the Fed. The target rate of inflation is 2%. We're not there yet. So why are we so confident that the Fed is going to start cutting rates?
Yes, good question. So I'd say there's 2 reasons. The first is that the Fed actually have 2 things that they're trying to influence. One is inflation and one is unemployment. And since they last increased interest rates in July last year, we've seen the unemployment rate rise a little bit, and we've seen the inflation rate come down from 4 to around 2.5. So clearly the factors that they're trying to have an influence on have changed, and so some readjustment of policy makes sense given that. And then I think the second point, and this is something that makes a central banker's job very difficult, and that's that the monetary policy decisions that they're making will have an impact on the economy in 6 or 9 or 12 months' time. They're not going to have an immediate impact. So the central bank does need to really think about what's the unemployment rate or inflation rate going to be in a few quarters' time, rather than what is it right now.
I guess my next question is, when central banks, including the Fed, started raising interest rates, it was done fairly aggressively, very quickly. Can we expect rates to come down at the same pace as they went up?
So I think in terms of how we think about financial markets, actually the pace of cuts can be overstated in importance. The reason for that is typically, if you look at the periods through history when you get really fast rate cuts, it's because something sinister is going on in the economy, and that would be a sign that the Fed is concerned about the path of the economy. So for us, what's more important than how quickly the cuts are delivered is the fact that the next move is very likely to be a cut. It's very unlikely to be a hike, and also inflation has now come down to levels where the Fed can cut interest rates if the labour market worsens or we get some negative data.
Yeah, so for me, the key takeaway then from what you're saying is what's important is we're in an environment, and this is a global trend, apart from 1 or 2 outliers, it's a global trend where central banks are cutting interest rates. They're cutting interest rates in an environment where we've still got growth, which is very important, and that should be still good for equities and bonds. It's not a bad thing. It's not a sinister thing at the moment. It's generally a good environment. So I guess then my final question is, we went into this cycle with virtually 0 interest rates. Where do we think interest rates will settle back down again? I mean, what's a term that's often used? Terminal interest rates. So where do we see those? What's it going to be a sort of typical interest rate in the US going forward? Is it going to be 2%, 3%? What's it going to look like?
Yeah, so that's an interesting question, particularly because over the last 2 years, during this period when central banks have been fighting inflation and increasing interest rates, the economy has actually been more resilient to higher rates than many people anticipated. There's lots of reasons for that. One is that consumers in the US termed out their debt and took on these 30-year mortgages, which meant they haven't immediately felt the impact of higher rates in some cases. It's a similar story for businesses. Many businesses termed out their debt in 2020 and 2021. So again, they've felt the impact of higher rates slower than they may have in previous cycles, and that's meant the economy has been fairly resilient. Now, obviously, the extension of that is that because the economy has been more resilient to rate hikes, it does make it difficult to know the exact impact that rate cuts will have. And as a result, it makes it difficult to know exactly how far rates will come down. Having said that, though, we don't expect rates to return to the to the zero interest rate environment that we saw prior to the pandemic. There was a few unique elements to that economic cycle that meant that rates were very low. And if you look through history, that's actually quite rare. So we don't anticipate a return to those levels.
Okay, all right. Thank you very much, Joe. Monique, coming back to you now for the final point. I know you want to talk about market dislocations because you've done some research into these sorts of market events. And obviously this is off the back of the volatility that we saw at the end of July, beginning of August. And it'd be good to get your thoughts on that. But I guess we should probably start with explaining what we mean by market dislocations.
Yes, let's start with what is a market dislocation? In very simplistic terms, it's when markets fall out of bed. So markets have wobblies quite often. Yeah. In particular, the kind of wobblies I'm talking about is when the markets fall out of bed to the extent that it makes you feel sick in the stomach. Yeah. When this happens, there's usually a point at which the market decline has priced in far too much bad news. And it could be a buying opportunity for those who are looking to add value to their investment portfolio. So let me bring it to life. I'm going to give you an example. During COVID 2020, March 2020, the market fell by 30%. We were all sitting at home. We knew that the economy was in recession because the government had closed the economy. Everybody thought this was going to get worse. We didn't know when we were going to come out of lockdown. Nevertheless, 23rd of March 2020, if you remember, the day that we were all sent home, that was the day that the markets put in the low point. It rallied into the end of the year. Not quite in a straight line, but it rallied into the end of the year. And there's an intuition around this because, you know, the government came in with stimulus, the Bank of England and other central banks around the world cut interest rates to near zero, and they supported the economy and therefore they supported companies. And as we always say, companies underlie the stock market.
Yeah, absolutely. I mean, what sort of? I mean, you talked about the market collapse after the sort of we went into lockdown, and that was huge. But the research you've been doing, what sort of magnitude of market decline are you looking at? Are we looking at a 10% correction, which we know statistically happens on average once a year?
So that is the £1 million question. What is the level of decline? Because obviously we know that you can't pick the bottom. It's impossible. You don't know when the market starts to fall. Is it going to be a 5% fall? Is it ultimately going to be a 10% fall, a 20% fall? What you do know is that you want to skew the odds in your favor. So you have to set out what kinds of outcomes you're going to be comfortable with and on what time horizon. And this is going to be different for different investors. Now, we are long-term investors, so we're going to look at it from this lens. So I'm going to say we want a positive outcome, doesn't everybody? Yeah. And we looked at different time horizons historically, and 12 months horizon, a 1 year horizon produced the best outcomes. You asked about a 10% decline. As it turns out, 10% declines historically haven't produced the best outcomes because the likelihood of a positive outcome, the hit rate, I'm going to call it, after 12 months is circa 60%. So that's just a bit better than 50-50.
How are we defining a positive outcome? What are we saying? That the market has recovered the losses or has recovered the losses and then some in 12 months' time?
Simply, if you have a 10% decline or whatever decline that you define, in 12 months' time, will you have made money? Is your return better than zero? It's as simple as that. 10% decline, not really a big enough decline to be meaningful. 15% decline looks much better on the hit rates. In a 15% decline, your likelihood of a positive outcome after 12 months is circa 70%. So that is a better than 2 in 3 chance. And your median expected return of the order of 17-18%. So if I look at the recent market choppiness, end of July, beginning of August, the S&P fell 8% from the peak, which is uncomfortable, but by the definition which I've just given you, not enough to make us feel sick. So, you know, I would say also, this is a tactic that, you know, if you're thinking about buying the dips or buying the declines, is a tactic that should sit alongside being invested over the long term.
Yeah, absolutely. And I want to come to Japan in a moment, because that was obviously a much bigger correction. But so are we saying then that there is a link between the size of the correction and the level of the recovery, or the frequency with which you see that good sort of recovery?
In short, yes. So everything that I've talked about, all the numbers I've quoted, are largely based on the S&P 500, because that is where we have the biggest data set, even if it is less perfect when you go back further in time. We looked at 25% and 35% market corrections, and these had 100% hit rate historically. So in all of those instances, there was a positive outcome 12 months later. And the median is strongly double digit. I'm talking about 30% type returns. But, and there's always a but with these
Yeah.
these big declines are extremely rare in the market. We have had 5 instances of those in the last 25 years. And you need to think about COVID, global financial crisis, dot-com bubble burst. And if you've done a course in statistics, you know that you cannot extrapolate a definitive conclusion based on a sample set of 5 observations. But what we can do is we can have a takeaway, a rule of thumb, that the really big declines in the markets are the ones that you want to take advantage of. And the other thing is true, which is you don't want to panic sell.
I was going to say, we're not advocating this as an investment strategy necessarily for people, because we don't give advice on need to know. But what's important is it may be a buying opportunity, but also it's not an opportunity unless you absolutely have to sell your investments. I think that's what we're saying, isn't it? It's a difficult time for investors because, as you say, you feel sick in the stomach, but it is a time when you probably need to remain calm, because often historically, and obviously we can only talk historically, we can't make predictions for the future, but historically the recovery looks pretty good, and especially after these bigger corrections.
That's correct.
Okay. All right then. Now, I know a lot of the numbers you've looked at the S&P 500. So does that, what we've seen in the S&P 500 historically, does that play out across other regions?
So we did look at other major regions, Europe, the UK, Japan. The outcomes, I'm going to say, are pretty similar across regions, which is not surprising because the big declines that I've been talking about have been systemic events, the global financial crisis, COVID, dot-com bubble burst, meaning you had an economic crisis and it rippled across markets globally. It does sound from what I'm saying that you wouldn't discriminate in any region in terms of taking advantage of that decline, but you do have some considerations because you are translating analysis where there is no noise into the real world, which has quite a lot of frictions. Let me explain. So in stressed market conditions, markets are very whippy. You have up and down 10% days, liquidity is lower, trading is more difficult, bid-offer spreads widen. I'm trying to say that the number on the screen is not the price that you are going to trade at, very likely. So there's going to be some variability compared to the results of your analysis, and you have to factor that in. So when markets are stressed, the easiest, cheapest, most liquid market to trade in is the US. And the outcomes from the other markets that I mentioned, they're not appreciably better. So I think you can draw a conclusion from that.
I think we can. Well, I want to now talk about Japan, because obviously one of the reasons why we wanted to include this in this particular need to know was the market volatility we saw in Japan. You talked about the US. I think you said it was 8%. The S&P 500 was down. But in Japan, we saw markets. I mean, you talk about whipsaw. That we certainly saw that in Japan. I think Japanese equities were down 25% at one point. So let's take that research that you've done. Does that follow then that 25% correction in Japan, there's an opportunity? Do we see that rebound playing out in Japanese markets, or are there factors there that make that slightly more complicated and more nuanced?
So for Japan, I'm going to give you a short answer and a nuanced answer.
Good.
The short answer is yes, because as I said earlier, you want to buy the big declines. 25% fall is a big decline. The nuanced answer is that historically, Japan is not the best market to buy the big declines. In the analysis that we looked at historically, Japan was the most underwhelming region. The hit rate was noticeably lower, observably lower, and the expected returns were mid-single digits, where we were looking at double-digit returns in the other regions. And maybe that is not surprising because Japanese equities have been unremarkable. They took 35 years to get back to their 1989 high in the spring of this year. So, and as an aside, I'm going to say, when we had the 25% decline that we experienced, or that Japanese market experienced in end of July, early August, that one in particular was a dead cat bounce. So it fell 25% and it has recovered 20%. So you had to be very quick to catch that. And obviously, if you are US, UK, European-based investor or trader, you're doing that in the time zone when Japan is closed, when you come in and start your day.
Yeah, and this comes back to the old adage that gets trotted out every now and then about timing the market and timing the market. And timing the market is virtually impossible, isn't it? Even for the professionals, it's virtually impossible.
Yes,
yeah.
It's virtually impossible, if not very impossible.
Yeah, exactly. Okay, and as I say, just to reiterate again, we're not advocating a particular strategy. We're talking about the research that we've done, or not me, I should say Monique and her team have done, looking into what happens to markets in the wake of these big corrections, and some really fascinating data there. And I guess some comfort perhaps for investors who are going through market volatility and feel very uncomfortable. And as you say, sick in the stomach. We're talking about the corrections of that kind of magnitude and how important it is to perhaps focus on the longer term and not be distracted. And maybe there's an opportunity there if that's what you want to do and you feel comfortable doing that. But certainly it's about having that longer term view. And obviously we're talking about what's happened historically. It doesn't necessarily mean that that's going to play out in the future. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you very much, Monique and Joe, for joining me for this week's Need to Know. If you want to hear more on the recent market correction and the key drivers and some of the technical aspects of it, have a listen to recent episodes that David and I did from the 6th and the 16th of August. Until next time on Need to Know, bye for now.